Hello friends, welcome to our channel Money Tutor. I am Srinivas. Today we shall see the topic stock market basics for beginners. If you have decided to invest in stock markets, are you worried you don't know anything about stock markets? Are you wondering what is ROCE, what is ROE, what is bull, what is bear, what is Sensex, what is Nifty, what are candlestick charts, what is RSI, what is MACD, etc. etc. Are you wondering if you don't know any of these terms, then you may lose money in the stock markets? Then don't worry. You need not know these fancy terms to invest in stock markets. All you need is some simple common sense and logic. Today, we are here to bust the myths of stock markets and help you invest in stock markets using simple logic and common sense and gain profits. What is share or stock? A share is a small percentage ownership of a company. If you own the shares of a company, then you are a small owner of the company. If the company is growing and profits are high, then you earn something from your share. If the company is falling down, then you make losses. Which company should I buy? Which company shares should I buy? If this requires some little common sense and simple logic, observe the brands which you use every day and see which are popular. If they are popular, that means they are growing. The company is growing, and you will earn something from your share. See the companies which are going to other places. If they are going to other places, that means they have good response and that made the company go to other places. Also see the advertisement the companies are giving. If the company is advertising, that means it has made some profits out of its sales and is investing some amount from it to advertise. These little things help you to know which company to choose. Now, when to invest? See, if you are shopping, then when will you buy the clothes? You will buy when there is a discount. In the same way, when the prices are fluctuating, see the time when the price is at a low level, or you get the share at a discount and buy it. It will help you to gain profits when the price of the share goes up. Investor versus trader. Investor is a person who invests in the shares of a sound company and waits for the long term to get these benefits. He waits for the long term. He is a long term investor. A trader is someone who keeps buying and selling when price goes up and goes down. He will be doing his business whenever on short term basis, and whenever the price goes up, he will sell it, and whenever the price goes down, he will buy the share.
The table shows comparison between investor and trader. Investor bought shares in 2001 for Rs 50 each and sold in 2021 for Rs 1400 each. He made a return of 2700%. The trader in turn bought the shares in 2001 for Rs 50 each and sold them in 2001 itself for Rs 58. He made a return of 16%. Then in 2003 he bought shares for Rs 70 each and sold in 2003 itself for Rs 80. He made a return of 14%. In 2005, he bought shares for Rs 130 each and sold them in 2005 itself for Rs 150 each. He made a return of 15%. Similar way, he made other investments and got a total return of 133%. Friends, now you might have understood that real wealth creation happens only in long-term investments. Tell in the comment section if you are an investor or trader.
What is a stock exchange? Stock exchange is a financial institution which has a list of companies selling their shares. If you want to buy the shares of a company, then you need to buy it through the stock exchange. There are two stock exchanges in India. One is the National Stock Exchange NSE and another is the Bombay Stock Exchange BSE. They are stock bazaars where people sell and buy the shares of companies. What are Sensex and Nifty? Sensex and Nifty are indices which are calculated from the data of large companies listed in the stock exchanges. There are two indices. One is Nifty and another is the Sensex. Nifty is the index of NSE and Sensex is the index of BSE. What is the need of these indices? These indices are barometers for the market sentiment. That is, they tell if the market is bearish or bullish. Bearish means the market is going down and bullish means the market is going up. Now, common sense tells us that we buy the shares when the price of the share is low. But when we can say the price of the share is low, we need to see the history of the company and know the peak price, and then if it is available at a discount, then we need to buy it. If the company is making profits, then it's a good investment. A Demat account. If you want to put money in a bank, you need a bank account. In a similar way, if you want to invest in shares, you need a Demat account. Once your Demat account is there, you can invest in shares on both BSE and NSE. Who is a stockbroker? Stockbroker is a person who acts like intermediary, like a bank, and helps you buy and sell the shares from the stock exchange. Choosing a good stockbroker helps you ensure safety of your money and shares. Also, stockbroker gives valuable tips regarding the market. There are many registered stockbrokers. Choose them wisely based on clientele and reviews. There is a small brokerage charges which they charge. I use Zerodha because it is online, user friendly, and minimal brokerage charges. If you want to open account with Zerodha, there is a link in the description box from which you can open. Now, what are the timings of the stock exchange? Stock exchange is open from 9:50 a.m. to 3:30 p.m. It is open on Monday to Friday and is closed on government holidays. During this time only all the transactions happen. Now, how to trade using a Demat account? Step 1. Step 1 is find the company whose shares you want to buy. Step 2. Know the share price of that company. Step 3. Decide on how many shares you want to buy from that company. Step 4. Transfer the amount into the Demat account and buy the shares of the company.
The share price of SBI Bank is Rs 430 in June 2021. If you purchase one share, then your investment is 430 rupees. If you purchase 100 shares, then your investment is 43,000. The other combinations are also shown in the table.
Why do people lose money in stock markets? There are two reasons why people lose money in stock markets. One is they don't know the basics. Two is they are undisciplined or let emotions sway them. If you want to learn riding a car, you need to give time to learn the basics. In the same way, if you don't follow the traffic rules, then you are going to make accidents. You need to be disciplined, you need to learn the basics. You need not be a mechanical engineer to ride a car. In the same way, you need not be a professional in finance to know how to invest in stock markets. How to learn the basics? People often get intimidated by seeing the terms and formulae involved in the stock markets and assume it's a very challenging area and stay away from them. Don't worry, friends. All you need is simple common sense and logic. We are here to help you on your journey to make profits in the stock markets. In the meantime, just learn stock market basics from the newspapers by reading 20 minutes a day or follow news about the stock markets. Word of caution. You won't earn huge returns in stock markets in very short time. You need to give company time to become big. You need to give company time to grow. Then only you can expect profits in stock market.